The E-mini is continuing up to test that sell climax high. Here's the day session 15-minute chart, 240-minute chart. We have a double top, we have a strong breakout, and you can argue that the top of the sell climax began with this high, and the market looks like it wants to test that high. 60-minute chart right here, the top of the bear leg. If it gets there and reverses down, the bears will see it as a double top, lower high, major trend reversal. 60-minute chart. So possible double top and then a lower high. Right now we have a bull trend, a bear breakout, and the bears are trying to get a lower high major trend reversal. If they get it from around this price, that would be a double top, lower high. Again, 60-minute chart. And measure move down takes us there. And we could start getting cascaded stop runs below every major lower high. I think the target is either the May or March lower highs. Excuse me, higher lows. Stop runs below the higher lows. I think the target is somewhere down here. We still might get one more new high. If we do, and if we reverse down, then it'll be a higher high major trend reversal and an expanding triangle, up, down, up, down, up, down, up. And then if it reverses down, that would be another major reversal pattern. We had an expanding triangle here, up, down, up, and then down. And then usually an expanding triangle top is followed by an expanding triangle bull flag, which we got. And eventually the pattern evolves into something else. The bears are hoping it's evolving into a lower high major trend reversal. Bear breakout below the trend line, and then a lower high, and then a series of lower highs taking us down to the May or March lows. 2 days of tight trading range. So it's a magnet, and that reduces the chances that the bull breakout will get very far. It also reduces the chances that if we get a bear breakout, it'll get very far. It increases the chances that today we'll have a lot of trading range price action again. The magnet is here around 2474 and a half, about 5 points above where we are. 2 days ago, the first bar was the low of the day. Yesterday, the first bar was the high of the day. And we have a magnet just a few points above. Yesterday, I think this reversal was the key event of the day, and the bears have not done enough to erase that, so that's still, I think, the dominant force operating in the market. Plus we have that magnet a few points above. Globex market sideways for about 6 hours, but a bull trend. So bull trend, bull flag, breakout attempt, a lot of sideways bars. Might have to test down. The bulls might need a double bottom before they can get an upside breakout. We're almost 4 minutes into the bar, and so far it's a doji bar. Yesterday we began with a pair of doji bars, and when you get that early on like this, it increases the chances that the day will have a lot of trading range price action. It's telling you that right at the outset, the market does not have conviction. We could still close on the low and then test down to the moving average. We can still close on the high and form a trend from the open bull trend like we did 2 days ago. A gap up, and the first bar closed on the high, second bar closed on the high, and then we had a trend day. So far, this is a trading range bar. We're gapping up, but we're spending a lot of time in the middle of the bar. We have FOMC minutes coming out at 11 o'clock today, and there's always the possibility of a surprise, but it's a small chance. So if there's a bear close, especially a 2 or 3 tick body, bears will sell the close. Okay, 1 tick bear body. So while a little bit more bearish than bullish, a lot of the bears will not sell the close. You can see, look at the open of 2 compared to the close of 1. You see how it's 1 tick below? That tells you that as soon as the traders saw the bear body on 1, they hit sell the market. Even though 1 is not helpful, it's not giving us any information, it's a neutral bar, there's still a 20% chance it's the high of the day and a 20% chance it's the low of the day. We opened above yesterday's high and we closed the gap almost immediately. And a lot of times when you gap up and get a bear bar, you get a pullback to the moving average. And that's why some bears sold the close of 1. They're expecting it to test down to the moving average. The close of yesterday is right near the moving average, so they expect it to test down to the close. I said that yesterday, that we probably were going to test to the moving average. Close, it's near the close, so you think that they'll test the close as well. Bulls hoping that 1 is a bear trap, a bear body, tempting bears into selling, but it's only a 1 tick bear body, and the bulls therefore were able to prevent a reasonably good bear body, and they're hoping that this is the low of the day. As I said, 20% chance, that means 80% chance it's not. And with all the trading for the past 2 days, the odds are we're going to test down near the moving average within the first several bars like yesterday. Suppose 2 is a bull inside bar. Well, that would increase the chances that this is the low of the day. It would maybe make the odds up to 25%. If bar 2 is an inside bar, then it's a breakout mode bar. If it closes on its high, as I said, it would increase the chances that this is the low of the day, so it would be an okay swing buy. If it closes on its low, it would increase the chances that this is the high of the day, and therefore an okay swing sell. But the reality is, we've had 2 days in our trading range. We have a doji for the first bar. We have a gap up that failed immediately. You have to assume, right now at least, that we're probably not going to go very far up or down. Yesterday was a small range day. That increases the chances that today could be an outside day. Here's the daily chart. Yesterday's small range day. So it increases the chances that we could trade above yesterday's high and then trade below yesterday's low. I think it's important that yesterday was a bear bar instead of a bull bar, because it reduces the chances that we're at the start of a big reversal up, and it increases the chances that either we stay sideways or we get the lower high and the second leg down. Consecutive bear bars, but neither one closing on its low. Is it always in short? I'm not sure. You can see the traders who sold the 1 close made money. They get filled on the open of 2. It had to fall 5 ticks, which it did. So we know already that limit order bears have made money, even though we gapped up. Traders believing that we're probably going down to the moving average, but limit order bulls, just like yesterday, they bought the low of 1, they bought the low of 2 because of the big tails, or they bought 1 point lower. Here the moving average is further down, it's a couple points down, but limit order bulls probably will start buying at the 2 low. They buy the 2 low. They tried to buy more 1 point lower, and they could not. You can see it reversed up from 1 point lower, in part because probably too many buy limit orders there, either from the bulls who bought the 2 low and tried to buy more 1 point lower, or from the bulls who did not want to buy the 2 low but did want to buy, and they started buying 1 point lower, and they want to buy 2 points lower, 3 points lower. Still close enough to the moving average so that we'll probably go a little bit lower, and therefore I think not a very high probability buy at the too low. Remember, we have that magnet above. The 15-minute chart, this top of this sell-off. So that's a magnet. You can think of it as a buy the close bar that never got tested, and it looks like we're trying to test it. And then magnet below, small range yesterday. The bears want to get outside down, but I think we have to get up to here. And then the low of 2 weeks ago was a very important price. Weekly chart. Last week was an outside week, closed far below the low of the week before, but now we're back above that low. And the bulls want to get back above that high, which is this green line up here. Possible low of the day, but 3 dojis, no bull bars. Still only a 25% chance it's the low of the day. Always in long or short. Well, even though we have no bull bars in the first 3 bars, it's probably slightly more bullish than bearish. So it's still always in long, but it would not take much to change it. 3 basically dojis sideways for the first several bars. We have that magnet above at 2474.5, so about 5 points above. That's that top of that leg down. On the daily chart, it's this high, the top of this bull bar. And the bears want outside down. The low of yesterday, obvious target. It's right around the 60-minute moving average, another target. Now, we broke above yesterday's high and reversed down on 3. We broke again above yesterday's high here on 4, and the bears are trying to reverse down a second time. So this would be a slightly higher probability short below 4 compared to below 2. Okay, so if it falls below 4, then maybe 30% chance this is the high of the day. The reason why I'm not saying more than that, sometimes it's 40%, right, 50% depending on context. Here we're in a tight range, and I think the traders are not expecting a big move up or down, and they're expecting reversals. Traders made money buying below the bear bar 1, and they made money selling at the high of the reversal bar 3. So far, limit order market. Everyone wants a trend. Well, so far, there's no reason to think that we're in a trend, right? We need consecutive strong trend bars up or down. Limit order market, but a reasonable swing sell, right? But the problem is, look at the first 4 bars, reversing every bar. We're just not going anywhere. So that's a swing sell below 4. Bulls want a high 2 buy, high 1 above 3, high 2 above 5. But the bulls so far do not have a bull body. You can see traders are looking at this as a limit order market. They bought below 2, they sold above 3, they're buying below 4. I think the math is okay for the bears taking a chance at the high of the day, but all the reversals and the tight range make it probably not high enough for a scalp below 4. Yesterday tested the prior day's high twice, and the sell signal was below 7, and look what happened immediately after the market traded below 7, and it only went 1 tick back above the 7 low. Today we went below the 4 low, which is comparable, and we immediately reversed up, right? So much less bearish than yesterday. For the bulls, a bear trap, opening reversal up from yesterday's high. But unless we get, or until we get, one or two decent trend bars, a lot of traders are hesitant to take swing trades. Not a good looking buy setup, not a good looking sell setup. The bears have sold below 4, trying to sell more here and stop the market from getting above the 4 high. Some bears would get out above 5, but I think if you sell below 4, the stop is above the sell signal bar 4. And for the bulls, a lot of bulls are not buying 5 because tight trading range and prominent tail on top. A lot of bears who normally would be scalping, selling above, did not sell above because of the failed low 2. Suppose we get another bear bar on 6. Well, that would be good for the bears, but it's still a tight trading range, and a lot of traders do not want to trade with stops until we start to get trending type bars. Probably a report at 7 o'clock, so I might get a breakout or a reversal. Nobody wants to buy at the top of a tight range. Let's say we get another bull bar here with a 3 or 4 tick body closing on its high. That would increase the chances that we're going up to that target about 4 points above. By bar 7, 50% chance we've seen either the high or low of the day. And you look at this and you say, that doesn't look like a good high, it does not look like a good low. But the reality is 50% chance 1 is either going to be the high or 3 is going to be the low. Bulls trying to get 3 consecutive bull bars, but the bars are small, and that makes traders hesitant to buy high and hesitant to sell low. I still think we're always in long, even though we had 4 bear bars at the start of the day. You know, maybe we went always in short below 4, but I'm neutral. You know, look at stop order traders below 2, below 4, above 3, above 5. Bulls trying to get a move up to that target above. This is the target. This is the 15-minute chart. The top of that final leg down. Limit order bears probably sold above 5, probably sold above 1. I am currently flat. Limit order bears selling 1 high probably will make money. They need a 1 more tick drop. Stop order bulls hoping that although 5 was on a good buy signal bar, 6 closed on its high, so they're hoping that 6 is the start of a swing up, but bad follow through 7 and then big tail 8. So, and then we're also back below the 7 high, so that weakens the bull case. Again, second reversal down from above yesterday's high, but a bull bar on 8 and a limit order market, so not a great sell. Bulls, will they buy below 8 hoping to get a channel up? They might. You know, I think it's probably better to be waiting. Still always in long. That only means it's slightly more bullish than bearish. We have a gap up. We have a failed sell below 4. We have a new high of the day. But it's really, it's a limit order market. Even with it long, bears are making money selling above bars. So it's not bullish at all. It's barely more bullish than bearish. Getting near the end of the first hour. 2-day tight trading range, and we're breaking out. So far, a doji bar, the bulls would like to close on this high. They want to get up to this high. Still barely always in long, slightly more bullish than bearish. Market trying to test that magnet above. Suppose the bears get another reversal here. Well, I still think traders would like to see a good sell signal bar. Otherwise, they'll buy below bars. They even bought below 4, which was a decent sell signal bar. They bought below 8. Math is difficult here. The reward is about 4 points above where we are. And the risk right now, probably below 9. If we're in a channel, you don't want the market to go below even a minor higher low like that. We're getting near the end of the first hour, and this is the target, the top of that sell-off. Limit order bears probably sold the 9 high, probably will sell the 8 high as well, hoping for a wedge, 1, 2, 3. I think most traders should be flat. Too many sideways bars here, here, too difficult to make money unless you're trading with limit orders, and starting out trading with limit orders I think is too hard to do profitably. You're buying when the market's going down, you're selling when the market's going up, and emotions can interfere with decision making. Bears want the wedge, bulls want the breakout and the move up to the target. Slightly more likely that we'll get the breakout than it is that we'll get the reversal. But without the breakout in the next bar or two, then we probably will get the reversal. This is the end of the first hour. And it looks good on the 60-minute chart, even though not so good on the 5-minute chart. This is an important bar. Sometimes it makes a dramatic change in appearance in the final seconds, to become either a big bull trend bar closing well above the 8 high or a bear reversal bar. So you got to be prepared for either one. Okay, we got neither. Okay, that's the high of the 60-minute bar, and we just broke above the high. But so far this breakout is not strong enough to make a lot of traders chase it up. You know, 11, 12, those were opportunities for the bulls to get big bull bars closing on their highs. And the bulls were unable to do that, and that increases the chances that the rally is a bull leg and what will end up as a trading range day. Bears trying to get the wedge top, and the problem they have a couple. Well, the main problem is the channel is tight, and therefore unlikely to go straight down. More likely a minor reversal and sideways. And for the bulls, the bears have been making money today, and the rally is not having consecutive big bull trend bars closing on their highs. So the bulls know this is probably not going to be a strong bull trend day. I think a lot of the bulls will get out below 13, and for the bears, even though you have a small wedge, the channel is tight. We've only had one little pullback, and it's only a few ticks, so it's not a high probability stop entry sell. Suppose we reverse down sharply, well, then the probability will go up. So possible high of the day, but chances are if it triggers, it probably will trigger, but if it triggers, we'll probably have to go sideways for a few bars before the bears can get it to go down, if it goes down. Can you buy the 12 low, 13 low? We're still always in long, and one tick tail on the bottom, I would not take the buy. Sometimes I'll buy below a bear bar like that if there has been very impressive buying before the bear bar, but the buying through here is not impressive enough for me to buy below that sell signal bar. The bulls are trying to prevent the sell from triggering. They're trying to prevent 14 from trading below the 12, 13 low. So you have bulls buying right here with the stop below 13, so they're risking 2 or 3 ticks. Whenever you risk only 2 or 3 ticks, you usually lose money, and that means we're probably going to drop at least a tick below 12 or below 13. Not high enough probability for a scalp below 1. The swing bears taking the sell, betting on a high of the day, probably will have to sit through the market going sideways. So if it goes below 13, it probably will. It probably will go more sideways than down. And then after going sideways, it might go down. Remember, the bears needed to get below 13, and the bulls know that, and the bulls are trying to prevent the sell signal. So they're buying, and they want to get a break above the 13 high. They've been trying to get the breakout. Here it failed. Here it failed. And they'll try again here. Now, you have not heard me talk about a small pullback bull trend day. Whenever you have a rally that looks like a bull leg in a trading range, you have to be thinking about the possibility of a small pullback bull trend day. The reason I have not mentioned it is because we're not getting gaps. Small pullback bull trend days usually have gaps, usually 2 or more gaps, and we're not getting gaps. You can say gap 13 low, 9 high, but I think too much overlap. And therefore I think it's more likely this is a bull leg in a trading range day and not a small pullback bull trend day. Okay, small pullback bull trend day, gaps. Even here, it looks like a weak rally, but we're getting gaps, pullbacks above breakout points all the way up, pullback staying above a breakout point. A little bit of overlap with this one, right? A little bit of overlap here and here, but gap here, signal bar high. It's just, plus in this day, very few bear bodies. Gaps, more bull bodies. Even here with a lot of bear bodies, gap between that high, that low, gap, this low, these highs. And we don't have that kind of strength today. Bear bars, but little gaps. Nine overlapped these highs too much, and 13 maybe a gap, 9, but I'd like to see at least one more gap before I start thinking that this is a small pullback bull trend day. tight channel, so bears not getting credible sells, and the market just keeps drifting up. The best the bears probably can get over the next few bars is sideways. More and more traders believe that the bulls are in control, getting a breakout here. Bears hoping for a parabolic wedge. There's something wrong with the rally, but the bears are not able to create much selling pressure. What do? Parabolic wedge, we're getting a bull breakout above a tight bull channel. But because it's a tight bull channel, if we get a reversal down, it's usually minor and the market goes sideways. Similar to this, pretty tight channel, bull breakout above a tight channel, and first reversal was sideways for several bars. So it looks like we're doing this. Not a good short, not a good buy. I'm currently flat. Parabolic wedge so far. 8-bar bull microchannel. So it's similar to what we had over here. Bull microchannel, and then a doji, a failed breakout above a bull channel, and the market went sideways, and that's probably what's going to happen here as well. So this might be what the next few hours look like. What about selling the 17 high? I'd like to see a reversal down first, and I'm not buying up here. Hesitation, right? Possibly sellers above. We have a wedge and then 3 dojis, so not a strong stop entry buy. We still have that magnet up there, about 2 points above where we are, and always in long. Let me take a look at a 10-minute chart, just out of curiosity. That's interesting. No bear bars, so it looks a little bit stronger than the 5-minute chart. What about the 15-minute chart? 2 or 3. This might be a third bull bar, not all that big, but still always in long. When a breakout or when a channel is very strong, bulls will buy at the market. When a channel is weak like this, a lot of the bulls want to buy a pullback, and therefore we have a relative absence of buyers up here. The bears want to sell, but they want the market to start to go sideways first. They want some evidence that the bulls are unwilling to buy. And, some bears might start to sell above 17, but I think it's better to wait until we get a pullback, like after that wedge from a couple of days ago over here. Same kind of thing, very tight channel, trying to get a bull breakout above the top. 1 pullback, 2 pullback, and then 3. Try to get a bull breakout above the top. Bears, at least here, had a bear body. And then once we started to get pullbacks, traders bet on our tight trading range and started selling above bars and buying below bars. And we went sideways. Today we have the bull breakout above the bull channel, but no bear bars here. Plus we have, I think, an important magnet above. While I think most traders don't think of small pullback bull trend days in terms of gaps, they are looking for some sign of strength. And in the absence of that strength, I think a lot of traders are hesitant to buy up here. Do I think it's reasonable to sell here? It probably is, but the problem is stop placement. We have a target at 24.74.5, so you'd probably have to put a stop at least a few ticks above that. I think it's probably too early to sell. $60-minute chart, that is the target. Same thing, right? Parabolic wedge. But when the channel is tight, the first reversal down usually is minor and the market enters a tight trading range. Sometimes the tight trading range is sloped somewhat down, but usually a tight trading range. Again, this is similar to 2 days ago over here. Rally, rally. Today's rally, I think, is flatter than this, less strong. And this is what we got. Started by going down a little bit, but stayed sideways for hours. And that's probably what we're about to do here. Limit order bears 16 high, need 1 more tick. They probably will get it. That would mean that the limit order bears are starting to make money, and that is an early sign that a trend is evolving into a trading range. Can you buy the 19 low? I would not. We have a parabolic wedge and just not a lot of buying. You can make a case for a gap here above the 6 high and these lows, but I think we have too much overlap in here, so I think it's really not a significant gap. Unlikely to go straight down. More likely, this is the start of a trading range that'll last a few hours. All the bulls knew it was a weak rally and it's running stop. So all the buy the close bulls now are exiting. And you sell the close 20, betting that it's the start of a swing down. I would not, although I think traders will start selling above bars. They sold above 16, made money. They sold at the 17 high, used wide stops, and made money. Probably a minor reversal and a trading range. Can you buy the 20 close and use a wide stop? I think the rally is weak enough so that we're probably going to get down to the moving average. Maybe the top, maybe the bottom of the 14 buy climax low. So, while you could buy, I probably would wait to see what we get over the next 2 or 3 bars. Will the bears get 3 consecutive bear bars and surprise us and reverse it down? Or more likely, will we just go sideways? It's enough of a big up, big down to make a lot of bulls wait to buy a micro double bottom. So instead of buying above 21, they'll wait to see if we go sideways at the moving average and get a double bottom. So up and then down again. This was a bond breakout, and this is disappointing follow through, so I just got out. I think you can see that 20 changed the character of the day. So right now I'd say 19. Remember, first 18 bars of the day. Usually if you get a breakout above the high, which we did, 90% chance you're not going to break below the low. Well, we went 1 tick above the high and did it on bar 19 and reversed down. And 10% of the time, you'll get a breakout above the first 18 bars and a breakout below the low of the day. And since the range is so small, this is probably better than a 10% chance that we'll get to a new low of the day. Is it 50% chance? No, but it might be 20%, 30% chance. And then every bear bar that gets added increases the probability. Whenever you have a lot of trading range price action and the open is in the middle third, the market tries to test back to the open. Are we always in short yet? No, but I think we're probably in a trading range. And I think there probably will be sellers at the 21 high and maybe the 22 high as well. And for the bulls, big enough down so they'll wait for a micro double bottom. So first reversal up, they'll wait for a second reversal up, like a triangle. 1 up, 2 up, 3, and then they hope for up. 20 gap bar buy. The market has not pulled back to the moving average for 20 bars. That means traders have been willing to pay more than an average price for 20 bars. That usually means that if they get to buy down at the average price, they'll buy. But 2021, good enough for the bears to make me think sideways more likely. Testing the bottom of the small buy climax, the 14 low and the moving average. But 2 bear bars, I think a lot of bulls will wait to buy. Also, 2 bear bars is not enough to scare out the bulls if the rally was really strong, but this is not really strong. It looks like a bull leg in a trading range. Not only did limit order bears make money, stop order bears made money as well, and that makes bears more willing to sell. Similar to this, stop order bears made money, so bears start to sell above bars. I would not sell above a high 2, but they sold above that, they sold above this, they sold above this, above that, and bulls bought below bars, below bars, below bars. So we're probably in the early stages of a limit order market type trading range. Probably sellers above 22, even if it has a bull body. But if it's a decent bull body, a lot of bears will not sell at the 22 high. They'll try to sell a tick or 2 higher, maybe around the 19 low, maybe around the 20 high. Think about the bulls at the 19 low. Was it reasonable for them to buy that low and scale in lower? While I would not do it, it's probably reasonable, and therefore we probably will get back to the 19 low. I don't know if we'll get 1 tick above it, but I think we'll get to it or maybe to within a tick of it. And therefore a lot of the limit order bears looking to sell above 22 instead will sell a tick or 2 below 18, which would be a couple ticks above 22. Becoming increasingly likely that we'll get the break below the low of the day. Here we broke above the 18 bar high, just like today, and this is what we got. We're not likely to get that today, but we're doing this right now. So bears will sell a rally, hoping to get down below the low of the day. And once it broke below the low of the day, did not get back up to the high. The reversal up became a lower high, so traders look to sell the rally. Here we broke above the high of the day and sold off for the rest of the day, never got down to the low of the day. Expanding triangle. We broke above the 18 bar high. The high of the first 18 bars is here, and reversed down, never got down to the low, even though we sold off strongly, repeatedly, never got down below the low. Are we always in short yet? The bears probably could have done it if 22 was a bear bar closing on its low, but they were unable to get that, so we're still probably always in long. We're getting near the end of the hour, and you can see the first hour is a bull bar, and second hour so far is a bear bar. Maybe an expanding triangle top, up, down, or down, up, down, up. Five-minute chart, up, down, up, down, up. So it's an expanding triangle. When you have a day with a lot of trading range trading, the open of the day is a magnet. Bulls probably buying 22 low, but they're probably scalping, and bears are looking to sell above bars, above 23. I don't know about above 24. I think the bears would like to sell a little bit higher. Stop order bulls, I don't know. I think limit order bulls are buying. They'll buy the 22 low, try to buy 1 point lower, try to buy the open of the day. But a stop order bull, I don't know, we've now had 6 bars down. I still think the bears need to do more to make it clearly always in short. They had a chance with bar 22, but could not get a bear bar, could not get a close below the moving average. And strong enough down, a lot of the bulls will wait for it to go sideways before buying with stops. Limit order bulls bought the 22 low, and they'll take profits a point above. You have other limit order bulls who bought the 19 low, and they're buying more above a bull bar, 24, hoping that it gets back to the 19 low. Their average price is right here, and usually traders doing reasonable things can avoid a loss. The market has to get just above this red line for the scale in bulls to avoid a loss. I think we will get above that red line. I think it was reasonable to buy the 19 low, and the bulls add on above a bull bar, 24. If it goes down a little bit more, they'll add on more. And therefore, the bears looking to sell probably are not going to sell the 24 high. They'll look to sell around here or higher. So this would be the minimum price, I think, for the bears to sell. So just above 24.71. You can see bar 24 closed off its low, and that put a tail on the bottom of the 60-minute chart, the bar, and it made it a weak sell signal bar. So consistent with the market probably going sideways. Big up, big down, big confusion, and probably more limit order market. Bears do not want to sell too low. They want to sell somewhere in the upper half, so somewhere maybe a couple ticks below 19. And probably most of the bulls are scalping. The bulls who bought the 22 low, for example, or even the 22 close, are probably going to scalp out, which means there will be sellers just a little bit above where we are. Sometimes when you get a breakout of the bar, the first 18 bars, you get a deep pullback, and then you continue up. But I think this pullback is too deep. Breakout of the 18 bar range and pullback that lasted a lot of bars. We got some trend resumption up. Breakout of the 18 bar range, deep pullback, but lots of little legs down, around a 50% pullback, micro double bottom. I think this is a more likely buy setup than what we have so far today. Breakout and then pullback, pullback, pullback. So, this is probably the best the bulls get is trading range for the rest of the day. breakout went up quite a bit before we got a pullback. Much stronger bull trend day, 18 bar high breakout, and we just went up. This might be like today, but the sell-off here had several consecutive bear bars. We do not have that today. The bulls got the resumption up, which is what we're trying to get right now. We're trying to get the resumption up. And the bears got a lower high, major trend reversal. So bull trend, bear breakout, lower high. And they got a big bear trend. Breakout to a new 18 bar high, and then a disappointing pullback. 2 bear bars and a bull bar. I think this is what we're doing. Right now, it's too early to say that we'll be sideways for 10 bars like this, but the 2 bear bars and a bull bar, 2 bear bars and a bull bar, I think increases the chances that we're going to go sideways. If we break to a new high of the day, probably sellers above. This is probably going to be sideways for the rest of, or at least for another couple of hours, maybe into that 11 o'clock report. You can see why I said the bears did not do enough to make it always in short. That bull bar 22, I think, weakened the, lowered the probability that the bears had taken control, and it made it more likely the reversal was going to remain minor, which means a trading range. Probably most of the bulls who bought will scalp out. They bought the 19 low, bought it more lower. They bought above 24, probably scalping out. I bought the 22 low, and I'm back to flat. We're in the sell zone, but the bulls have 4 consecutive bull bars. So a lot of traders are hesitant to sell, or if they did sell, they're probably trying to get out break even. It's a strong enough reversal up to make bulls want to buy below bars, betting that we'll get at least a little bit more up. To me, we're getting big up, big down, big up, big confusion, still always in long, but not very bullish, and probably sellers above the high of the day if we get up there. For the bulls, a bull trend, a pullback and a bull flag, a break above the bull flag. 28 is a high one buy, but I think most bulls want to buy a pullback below 28 and not with a stop above 28. Still always in long, but trading range likely. Where do the bulls buy again? Do they buy the 28 low? I don't know, it's fairly high up in the range. They'll probably buy around the 24 high if we get there. We have a little bit of a breakout, 27, so it's a little bit of a buy climax. They'll probably buy there, but I think they'll be less willing to buy with a stop above 29. And if we do get to a new high today, probably sellers above. Remember, on these breakout days, where you get the breakout above the 18 bar range, and then you get a deep pullback like that, usually do not get a big bull trend. Okay. Protracted pullback, not a big bull trend. Deep pullback, not a big bull trend. This is kind of like what we have today, right? And even if we get back above the high of the day, probably sellers above. The pullback today is like this. It's too deep. And when you get a deeper pullback, usually it's the start of a trading range and not a bull flag leading to a resumption of the bull trend. Bonds, I bought the breakout and then exited up here because I did not like the 2 bear bars and the 4 bar tight range. I did not buy again. I'm flat. It is interesting to me, when we sold off here, I said there was still only a 30% chance we'd get down to the low of the day, despite the reversal. If it becomes clearly always in short, then the probability of a new low goes up. The bears are hoping for some kind of a major trend reversal, a lower high or a higher high. But I think we're probably going to be sideways going into that FOMC minute announcement at 11 o'clock. Probably sellers above 29, sellers above the high of the day. How far up is your stop? Well, it's hard. When you have a lot of trading range price action, you have to use wide stops, like maybe a measured move up there or a measured move up here. Where would the bears sell? Well, it's a surprise reversal, and while they might sell 29 high, I think a lot of them are waiting to see what the breakout looks like, or the breakout attempt. Will we break above 19? Will we break strongly above 19? Remember, we still have that target up there at 74.5. The target is this high. It looks like that's what we're trying to get, we're trying to reach. Bears probably will sell here. I think it's reasonable to sell here, but the reversal up is a surprise. It's surprisingly strong, and that makes a lot of bears hesitant. You have bears selling right here, just below the 19 high, betting on the double top. Other bears selling the 19 high, but we have that magnet right here, 74.5, and we're reversing up with decent momentum. Makes me think we're probably going to get there. This pullback is deep enough to make me not want to buy up here, so I'd rather be buying lower. Small expanding triangle, 1619, small final flag. Can you sell with a limit order at that target, at that high? There probably will be sellers there. Certainly a lot of the bulls who bought for any reason will take partial profits there, and bears might sell there. It's reasonable. Better be looking for a reversal down from that price. Should be a buy vacuum up to that price here, so a lot of bears will wait to sell. Buying right here, you're within 4 ticks of the target, and it's a resistance level, so it's probably too late to buy. What about a stop entry sell? It's the same problem that this one had, a very tight bull channel. It doesn't matter if you get the wedge. It's better to be selling with limit orders above bars, above 16 or above 18, than with stops below. Target for the bears, the bottom of the buy climax here, and that's only a few ticks, 4 ticks below. Moving average also. There's more inclined to sell with a stop if it closes on its low. I would not. I still think we're getting drawn up to that target above. Micro double top, maybe a very tiny wedge, 1, 2, and then 3. So it's a slightly higher probability sell than below 33. We got to within 2 ticks of the target. Now, is that close enough? Let me just check and make sure I get the price right. Sometimes I mess up the price. The price is, I don't know if that's correct. We did get to the target. The price is 24.74. So we get exactly to the target. So that's another reason for bears willing to sell up here. It's really fascinating how a single tick can make a difference. So for the bears, they want a perfect double top. They're trying to keep it. It's slightly higher probability for the bears if they can keep it from getting above the resistance level and get a perfect double top. A pretty good bull bar here, the bears would need a 2-bar reversal to get a 60-minute sell. Not a good sell below the bull bar on 35. Better to sell below 36, but I think it confuses things when you get the reversal below 35, a bull bar, and then you're being asked to sell below an outside down bar, which is usually a trading range bar. It discourages traders from selling below 35. It increases the chances that we'll go sideways, reduces the chances that we'll go down. Tough sell. Obviously not a strong bull trend, but it's still a bull trend. The bears want the double top, and it would be good for the bears if they can get a 2-bar reversal. In other words, they would like the current hour to totally reverse the last hour. So they would like this bar to be a big bear bar closing on its low, at the low of this bar. If they get that, that would be a pretty good sell setup for a double top, lower high major trend reversal. It looks like, they're probably not going to get it. We're 20 minutes into the bar and so far not very bearish. And the 5-minute chart does not look all that bearish. I put some of my short position back on up here. I'm not talking about day trading, I'm talking about over the next weeks to months. Bears trying to flip it to always in short, and it depends on what this bar looks like. If it closes on its low, then we probably are always in short. Remember I said the 60-minute chart has a double top, lower high, major trend reversal, a bull trend. We have a pretty strong break below a tighter trading range, tighter bull channel here, and this rally is probably going to be a lower high. And the bears are trying to get a sell signal bar this hour, but they want the bar to close on its low to get a 2-bar reversal in addition to the double top. The reason why I shorted up here is because I thought either we would get a double top, or if we go higher to a new all-time high, I'll sell more above, betting that either this is the top or we'll get a top from a slightly new high. I sold this right now as well. Normally I wait for the close of the bar, and I typically do, but the context is good enough, so I took a chance. The close of this bar is important. If it closes on its low, then 60% chance we'll get down to the 24 low or below. If it closes on its middle, or then maybe 50% chance. If it closes on its high, then the bulls will hope that it's another higher low. So the bulls and bears are both going to trade here, trying to alter or trying to affect the appearance of this breakout bar. All right, so that's not nearly as bearish as it could be, but I think we're always in short. Remember, trading range day, it's a bull channel day, but a trading range day, open of the day is a magnet. What happens if we get a bull bar, 41? Well, this is already, I think, disappointing. The bar is not particularly big and it has the tail, right? If we get the bull bar, then probably 50-50 chance we get a higher low, 50-50 chance we continue down to the 24 low. Right now, it's more likely that we're going down to the 24 low. Because the bar is small and the tail is fairly prominent, we're probably going to go sideways here. A lot of times when you get a reversal and the breakout is not particularly strong, the market goes sideways about halfway down, and the bulls try to create a higher low and trend resumption up, and the bears try to get a bear flag from this breakout and a move down. Remember the bears? I said the bears 24 high would probably be selling either the 24 high or a little bit higher. And you can see we're coming all the way back to that 24 high. Those bears, if they're using a wide stop, like a measured move up based upon the height of this, so a stop up here, will sell again below a strong bear bar, 38. And they try to get out break even on their first sell and then with a profit on their second sell. This is an area where the limit order scale in bears will be taking profits, buying, and we're near the open of the day, which is support, and the 24 major higher low, which is support as well. But right now we are always in short. Buy zone, right? 24 high, open of the day, 24 low. But I would not buy to go long. I would buy back shorts if you shorted on 41, for example, and then look to sell a rally. Strong enough sell off, probably second leg down, even if we reverse up for several bars. The bulls want a double bottom, higher low, 24, but they should not have allowed the two bear bars. What happens if 42 is a strong bull bar? Well, that will change everything, right? But right now, the odds are bears will sell any rally, expecting the market to get down to the 42 close, maybe the 24 low. The market sold off sharply here and rallied to a new high. I think this made the market always in short, and probably the best the bulls can get is a test of the 40 high. More likely, we'll go sideways for a few bars and try to create a low 2, maybe head and shoulders top, left shoulder head, and then right shoulder. The bears would like to get a measured move down, takes us down here. Right now, maybe a 40%, 30% chance we'll do that, get down that far. More likely, weak rally, bull leg in a trading range, not great follow through, 2 legs up, 1 pullback 2, which is what we had back here as well, 2 legs up, 1 pullback 2, and then a trading range. The rally today is weaker than what we had there, and the selling today is stronger than what we had here. The market's probably going to go mostly sideways into the 11 o'clock meeting. So probably not too much to do. Traders will probably sell a bounce, and if we get a bad low one sell signal bar 43, bulls probably will start buying below bars, below 43, below 24, below 9, yesterday's high. Bear case right now is better. We just went always in short. So it's easier to make money looking to sell a rally than to buy a bear breakout. Closed bears 42, disappointed 43. But as much as the bulls want this to be a failed bear breakout, it's still always in short, and probably sellers above. A lot of the sell the closed bears 42 would like to add on more, a point or two higher, and then look to scalp out, break even back at the 42 close. So there are buyers at the 42 close. Bears buying back shorts, and bulls know the bears will buy back shorts, so the bull scalpers will try to buy back around the 42 close as well. Right now, bears are trying to sell 1 or 2 points above the 42 close, looking for a test back down to the 42 close. The bulls are hoping this is like this, but it's different. 2 bear bars, bull bar, 3 bear bars. I talked about that at the time, that the bears did not do enough to make it always in short. They did do enough this time. Where do the bulls come back in? I don't know. It's possible that it's 2 legs down in a trading range day, but I think it went always in short. And this is a surprise bar. Surprise bars usually have at least a small second leg down. When I see these breakouts, my first thought is a measure move down, and an obvious choice is the open of the first bar, the close of the last bar, and that's always the first target. Looks like we'll probably get a new low today. We might get down to the 60-minute moving average. I don't know. Daily chart, that bear bar yesterday was a problem. You can see this high is exactly right here at the top of the bull bar. On the daily chart, the bulls want a double top, these 2 highs, break below the neckline, and that would run stops below this higher low and increase the chances that we get down to the other ones. And this is where I think the market is headed over the next 2 or 3 months. The May low, or maybe the March low, somewhere down here. So my targets are a little bit lower than what they've been talking about on TV, but we'll see. This is a bull trend and then a bull channel. The market usually tries to test down near the bottom of the channel, which is down here. So the technical targets are here. I know a lot of the people on television are not, they're just looking at the cash index, and they're thinking in terms of percentages, like, 3% correction, 5% correction. I think of it more in terms of support. All right, so a possible second leg trap in a trading range day. I am going to get, if this bar closes on its high, I'll get out of the remaining day trading shorts, but I'm still holding on to my swing shorts because, I think we're coming down here, and that's a huge profit potential. That's actually fairly interesting. Let me just talk a little bit about that. Let's say you're shorting here and you're looking for a move down here. Okay, so you're shorting around 2460, 2470, and you're looking for a move down here, which is 2350. So you're looking for more than 100 points. And how far up do you have to risk? Maybe 50 points, maybe up somewhere up here, right? So you're risking 50 points to make 100 points. So your reward is twice your risk. Is the probability at least 40%? I think it is. So mathematically, it's an okay trader's equation to be short here. Now, what about bulls buying above 46, betting on a second leg down in a trading range day? We had 2 legs up, 1 pullback 2, 2 legs down, 1 pullback 2. This was likely to get a second leg. We have the second leg, and it's an exceptionally big bear bar, and therefore a possible second leg trap. I usually think first of getting out of longs before I think about buying to get long. I think the Oisin bears will get out above 46 if it closes within a couple ticks of its high. And the bulls, I'm not sure that they'll buy. We have a possible gap. This bear bar, if it were 20 or 30 bars into the bear trend, it would probably be an exhaustive end of the trend. But it's only about 10 bars into the bear trend, and therefore it still could lead to a measured move down to around the 60-minute moving average. If it occurs 20 or 30 bars into a trend, 60% chance it's an exhaustive end of the trend, and the trend would stop for at least 10 bars. It could start up again after 10 bars, but normally it stops for about 10 bars. This is only 10 bars into the trend, so it's still probably 50-50 chance of a measured move down. I would get out above 46 if it looks like this. The day has had a lot of trading range price action, limit order. Traders have been making money all day. The bulls have bought the 24 low, the 42 low. You have to bet they're going to make money. This keeps growing. It keeps adding ticks onto the bar. Reduces the chances that will go down much from here over the next few bars. Okay, I'm out of my day trading shorts, but I'm holding on to my shorts, my swing trading. The shorts that I'm holding on based on the daily chart and weekly chart. Not a great buy signal for the bulls, but reasonable for the bears to get out of shorts, either above 46 or even at the market. To me, it's a big enough bar so that we're probably going to go sideways here. If bears do get out, they sell again below a bear bar. However, I would wait for a low too short. This is a sell climax, and this is a climactic reversal, a big enough up bar to make it unlikely that we go straight down. More likely, the bears will need like a low too short near the moving average. Bulls trying to get up to the sell climax high. I don't think it matters whether or not they do. I think we've probably seen the high of the day. Remember I said 90% chance once we broke above 18, 90% chance this would remain the low of the day. Obviously that's not the case now. Now it's probably 60% chance we're going to get to a new low. Rarely, if you go above the 18 bar high and then below the 18 bar low, you get a very big bear trend. Like this, 18 bar high, strong sell-off like what we have, and then maybe a bounce, and then you ended up with a big bear trend. That is not likely, but it's possible. Here, strong reversal down, never got below the low of the day. For the bears, another low one short, below 47. But to me, the reversal up 46 is too big, so I'm not selling below 47. It increases the chances that there'll be buyers below 47, and that will start to go sideways here. Trying to get the new low of the day. One other thing about days that have a lot of trading range price action and the market rallies and then reverses, a lot of times the sell-off will go exactly for a measured move down. So this is a target, as is the 60-minute moving average and yesterday's close. I think it's reasonable to exit shorts if it gets down to this target. It's a measured move down, a lot of trading range price action, and right near the 60-minute moving average. And aggressive bulls might buy with a limit order, betting on a bounce at the measured move target, but we're so close to the 60-minute moving average, we may go a little bit lower. Plus, we're very close to yesterday's close, which is always a magnet. But we're in the buy zone, right below the 46 low. The low of 2 weeks ago, that was a magnet repeatedly for 2 days. Limit order bulls who bought the 46 low needed one more tick, but the bulls who bought 1 point below got their scalp. This is the buy zone. We might get another low one. I would stop selling. I would only sell rallies now. It's possible this could end up as a big bear trend day. If it does happen, it probably will happen after the 11 o'clock FOMC minutes are released. Remember, I showed this as a possibility. New 18-bar high, and then strong sell-off, and then we just sold off later. Consecutive sell climaxes. The bears got their second leg down from this one, and we're in a support zone. We're right near a support zone. Measured move, 60-minute moving average, and close of yesterday. How big a problem is it that we did not reach the measured move, high of the day, open of the day? Well, it simply means we have a magnet below, but we have two other magnets below as well. And I think it reduces the chances that this is going to go up very far. It increases the chances that even if we go up for a couple legs, we'll probably come back down here later. For the bulls, it's a wedge, failed breakout low of the day, consecutive sell climaxes, but not a great stop entry buy. Reversal likely here or soon, but tight channel, probably a minor reversal. Even if it goes up for 5 or 10 bars, probably still a minor reversal, which means traders will sell it, expecting at least some kind of a test down. I would get out of shorts above 50 and wait, even though it's still always in short, and there's still room to the targets below. Always in bears, if they get out, they're supposed to sell, in my mind, they're supposed to sell below a bear bar, but I would not. We're in a buy zone, and we have consecutive sell climaxes. So probably buyers below at the 50 low, the 48 low, the measured move target, 60-minute moving average. If you take the sell, you got to be really fast to make decisions because the sell is probably going to be a scalp. Bulls trying to get a second entry buy. We're in the buy zone below 50, below the day, measured move target, 60-minute moving average, and yesterday's close. So I would be out of shorts. Aggressive bulls are buying. Can they buy for a swing? Tight channel like this, probably the reversal will be minor, so the bulls probably will only be scalping. Usually, if you're looking to buy in a bear trend, the first buys are limit order bears, and limit order buys, not stop order buys. Let's say 52 is a good looking bull bar closing on its high up here. Then the probability might be high enough for a scalp up. Looks like traders are hesitant to buy because of the magnets below. They think it has to go a little bit lower. Limit order bulls disappointed, and stop order bears, I think, are hesitant to sell. I think we're in the buy zone, and we're probably not going to fall very far before we reverse up. And then we have the report coming out in 5 minutes. This bar will probably either close on its low or close on its high in the final second, right before the report. At the end of the day, when you print a chart out, it'll look obvious, like an obvious buy or sell, but it'll be hard to place the order real time. I think we're in the buy zone, but I'd like it to go a little bit lower and reverse up. However, it may go up first and then down. 5 ticks above 50 low, bull scalpers able to make a point. Probably a minor reversal, even if we go up for 5 or 10 bars. Open of the day is a magnet. Probably this is a trading range day, and it probably will end up closing around the open of the day. The bears are hoping it's a bear trend day, but it's probably not. Consecutive sell climaxes around a measured move, reversing up. Bull scalpers 50 low made their profit. Probably buyers below 54. Probably buyers around the targets below. Limit order market like we had early on. Open of the day, probably a magnet for the remainder of the day. We may go a few points above, a few points below, but we'll probably close around the open of the day, and today will probably end up as a doji day on the daily chart. If it closes on its high or near its high, probably always in long, but still a minor reversal. Tight bear channel, first reversal up, usually forms a lower high, and we usually have to get some kind of a test back down. I think we're probably just going to oscillate around the open of the day for the remainder of the day. Are we always in long? Well, it's a minor reversal. It's probably enough so that we'll get a couple legs up, maybe up to the 45 high. However, I think we're going to be in a trading range for the remainder of the day. We went above the 18 bar high, below the 18 bar low, and this pullback is too big, I think, to result in a big bear trend here. Above the 18 bar high, below the 18 bar low, reversal, and we just trended down. This happened much earlier in the day than today, and even though this is a pretty good bull bar, I think today's reversal, given the context, is even better. Testing open of the day, and probably sideways around the open of the day for the rest of the day. Maybe 2 or 3 points above, 2 or 3 points below, and then closing within a point of the open of the day. So traders will buy below 56, they'll sell above 45, and expect the market to just, if it goes up, they expect it to come down. If it goes down, they expect it to come back up. Can this go back all the way to the high of the day? Sometimes you get days where you get a new high, a new low, and repeatedly. So new low, new high, new low, new high. But more likely this will be a lower high. I think we're always in long, but probably sellers within a couple points of the open of the day. So somewhere around the 45 sell climax high. 5 ticks above 55 close. So you had some bulls scalping out for 1 point after buying the close, and probably buyers below 56, and probably a limit order market for the rest of the day. New low of the day, new high of the day. You know, when you get these repeated new highs and new lows, you're basically forming an expanding triangle. I'm trying to find, well, here, well, this is kind of an example. New low, new high, new low, new high. New low, new high, new low, new high. So if we do get up to a new high, probably sellers above, and probably buyers somewhere below 56. Right now, I think we've seen both the low and high of the day, and that will probably stay within a few points of the open of the day, and then close around the open of the day for the day to be a doji bar. For the bears, a double top 46, other computers double top 44, but big enough reversal, good enough context, probably buyers 56 low or a point below 56. Probably sellers a point or two above the open of the day. So sellers probably somewhere up in here. What do you do down here? I think it's a buy. I wouldn't sell down here. Suppose we get to a new low. Still probably a buy. I did not buy the 57 low, but I am looking to buy. If it sells off, I'll sell later, but right now I think it's still probably a limit order market, and will still probably close near the open of the day. Down to one of the targets, the measured move. We still have the 60-minute moving average and yesterday's close. We're so close to yesterday's close, we probably have to get there. But it's a buy if the bulls get a bull bar here. Limit order market, so probably buyers below. They bought below 48, they probably buy below 55. Remember that example that I showed that I thought was a low probability event. No, that's not the one. This one, where we got the new low of the day, we reversed up strongly, and then we had a huge bear trend. New low of the day, reverse up strongly. Bears are hoping for a huge bear trend. Probably they will not get it. More likely we're in the support zone and we'll find buyers here. So will we do this, or will we get back and stay near the open of the day? More likely we'll get back and stay back to the open of the day and stay near it. I need at least one more bar before I'm willing to sell closes. One more bar after the current bar. We're at a support level, or several support levels. Yesterday's close and the moving average. That low on the weekly chart from 2 weeks ago has been really an exceptional magnet. You know, this is the third day now that we're getting drawn to it. I'm trapped out. We're at a support level, and usually support holds. Consecutive sell climaxes. For the bears, double top bear flag, strong reversal down. Usually you get at least a second push down, but I am flat. I mean, I'm short on my positions that I'm holding for the, for the next several weeks, but I'm flat here. A lot of times when the market transitions from a bull trend to a bear trend, the bear trend begins before the bull trend ends. So there's a time when the market is both in a bull trend and a bear trend. And therefore, you can get a wedge bottom or a wedge bull flag with the first push of the bear trend beginning before the bull trend has ended. For the bulls, consecutive sell climaxes, test of support, the low 2 weeks ago, the 60-minute moving average, the close of yesterday, but strong enough and big enough surprise, probably at least a little bit more down. Is this going to be a measuring gap, 55 low, 60 high? It's probably not going to be a measuring gap. It's probably going to be an exhaustion gap. This began at 9 o'clock. Today, the sell-off, you can argue it began at 9 o'clock. The sell-off did begin at 9 o'clock, but it just, to me, it looks like we went down relentlessly fairly early. Before 10, we started a relentless bear channel. And here, this reversal up is at 11, not at 10. So I think probably limited down, probably buyers below or not far below. So a low probability short. Limit order bull 60, making money. For the bulls, it's a micro double bottom and sell climax. Not a great stop entry buy. The location is good for the bulls, and you can see the limit order bulls below 60 made money. The limit order bulls below 55 had not yet made money, but we're starting to form trading range price action here. So we'll probably get back above the 55 low, and the bulls will probably make money. For the bears, I think a lot of the bears either bought back the shorts below 60 or will buy them back above 61. Do I still think we'll get back to the open of the day? Usually, if the market's going to close around the open of the day, if it gets more than 3 or 4 points away from the open, it does not get back there. So this might be too far for the market to get back there. If it does not get back there, we'll be left with a sell signal bar on the daily chart for a lower high. The reversal up is strong enough so the bears might need a micro double top. So today would be the first of the two tops, and then maybe a few days later we'll get a second top, and that would be a higher probability short. I still think the odds slightly are better for the bears that we've begun a correction. This is the give up bar, and we'll probably get a channel down to these lows over the next 2 or 3 months. Unlikely to go straight down, just like we had pullbacks on the way up and it looked like a bull leg in a trading range. if we go down here, it'll probably look like a bear leg in a trading range instead of a very strong bear trend. For the bears, a low one short, but at support, consecutive sell climaxes, micro double bottom. I think it's a low probability short, probably buyers below. Again, I don't know that we'll get back to the open of the day. I think at this point, it's more likely we'll close in the bottom half of the day and create a better bear bar on the daily chart. Bears trying to get a low 2 bear flag, but too much support. The bottom of a channel, yesterday's close, the weekly support, 60-minute moving average. Buyers or sellers below 63, probably buyers below. And when something is pretty obvious, when the probability is pretty clearly in favor of one side, usually you don't get it doesn't drop below 63. If it's too obvious that there are buyers below, it probably will not drop below there and give the buyers a chance to buy. It'll force the buyers to buy higher. Does that mean if it goes below 63, the buyers are not strong? Well, it would mean they're not as strong as they could be, but the odds are there are buyers below 63. So it's a low probability short. I think we probably have to get up near the 56, 57 low, because there were probably buyers at that low and they bought more above a bull bar, 60 or 62. And usually if you do something reasonable, the market allows you to avoid a loss or make a profit. That's the average entry price. So at a minimum, we should get one tick above that. What happens back at the 57 low if we get there? I think the bulls who bought there will be relieved that they were able to avoid a loss and maybe make a small profit, and they will sell. So you'll have bulls selling at the 56, 57 low. They bought there, they bought more here or here, and if they get back here, they'll get out around break even, that buy, and then with a profit here, and they'll be happy. Some bulls will sell right here. They're getting out, avoiding a loss. Other bulls will hold to see if they can get a profit. Might get to the top of the channel. We have a magnet here. Is it possible that we get to a new high? Not likely. More likely, the day is deciding between closing around the open or around the low. Probably back to always in long, and therefore we've probably seen both the low and high of the day, but probably sellers around the 57 low, top of the channel, and the top of the sell climax. And we may end up oscillating around the open of the day. Typically, it would not fall, 6 points below the open and then get back to the open, but that's what it's trying to do. Low too short, 60, lower high, but two obvious magnets above, top of the channel and the 57 low, and therefore it might be too obvious that there are buyers below, just like 63, two obvious buyers below, so it does not go below. Getting to the sell zone, the top of the channel, 57 low, and a lot of bulls are hesitant to buy up here because if they're buying, they want to make at least a scalp, and a lot of bulls use 1 point as the minimum scalp, so they only want to buy if they can get long 5 ticks below the trend line, which is falling. So 5 ticks below here is not the same as 5 ticks below here. So it becomes a little bit tricky to figure out how to handle the trade. And for the bears, a lower high and a bear channel, a low 260, but strong enough reversal up, probably buyers not far below, and I would say 70% chance we're going to get to that bear trend line above, whether or not we drop below 66. Low too short, but probably buyers below. Stop for the bulls is all the way down here, right? But the odds are there are buyers somewhere 65, 67 low and lower for a test of the trend line. We got to within 2 ticks of the 57 low. Might be close enough, but I think odds are this reversal up is too big, so unlikely to be a bear flag. More likely a higher low and buyers below. What about limit order bears 61? Would they scale in? I'm not sure that many bears would sell 61. I would not. So I'm not confident that it'll get down to the 61 high. It might get to a 50% pullback. It's close to the 61 high. Bulls failed low 2, higher low, room to the target above. But if the bulls buy, stop is still below 59. And for the bears, they're taking a chance that this is like this. This was low probability. This is low probability. Plus we have an obvious channel top. We reversed up from the channel bottom. 75% chance you're going to get to the channel top. The market's deciding, is it going to close near the low and create a better sell signal bar for tomorrow, or is it going to close somewhere in the middle and create more confusion? But even if we do get a good sell signal bar, the reversal up is big enough to create big down, big up, big confusion, and probably sideways for a few days. So lower high major trend reversal on the daily chart, but probably buyers below, and the bears will probably need a micro double top after this strong a reversal up. I am flat. I bought a couple times on the reversal, but this is getting very neutral. Target reached the top of the channel, and now the market's deciding whether it'll close around the open, making it a weaker sell signal bar, or close near the low, making it a better sell signal bar. But even if it closes near the low, the reversal up is so strong, a lot of bears will want a micro double top on the daily chart, and that means the downside risk below today's low is not great. In a fairly tight range, usually if it's in a fairly tight range going into 1245, it stays sideways into the close. Well, the bears a double top lower high and a bear channel, but a strong enough reversal up so that we're probably not going to fall very far. And it's getting late for a buy the close or sell the close finish to the day. 2 targets, the low of the day and the open of the day. We may end up closing in between the two, which makes sense. The reversal up is so strong, it creates confusion. So you would expect today to add to the confusion and not provide clarity. And, closing somewhere between the 2 targets or even back at the open of the day generates confusion. We have a double top lower high and a double bottom bull flag. I think we're always in long, but we're in a tight trading range and it's very late in the day, so not a very good stop entry buy 76. You can see the quick moves up and down. That's usually a sign of lots of big trades taking place, 100, 200, 500 contracts, sometimes 1,000 contracts. Bar 78. 30 seconds left. Right now it has 29,000 contracts. It'll probably double that in the final 30 seconds. $58,000 contracts. Pretty interesting day. It really is interesting how the low of 2 weeks ago is still controlling the market. On the weekly chart, last week was an outside bar. It triggered a buy, and then it triggered a sell, and it closed far below the low of the prior week. And we've been spending the past 3 days testing the low of 2 weeks ago. The bulls want this week to close above the low to negate much of the bearishness, and the bears want this week at a minimum to close below that low. The bears would like the week to close on its low, and they would like it to close below last week's low. Right now, that does not look likely. Daily chart, I talked about this. We've had several big sell-offs since the election. Here, bad follow-through. Here, very big sell-off, bad follow-through, bad follow-through, bad follow-through, bad follow-through plus tail, big tail, all right? And now this bar is most like this one. Well, excuse me, most like this one. A bear bar completely below the moving average and a break below a tight trading range. And here we reversed up for 8 consecutive bull bars. And here we reversed up for 2 consecutive bull bars. And now we have a bear bar, and today might be a bear bar as well. This reversal led to a new high. I think this reversal is more likely to lead to a lower high. And if it does lead to a lower high, the bulls hope that we simply go sideways and get to the moving average, weekly moving average, by going sideways. We're so far above, we probably would have to go sideways for 4 or 5 weeks to get, for the moving average to get up there. I think it's more likely that we're going to trade down. Sometimes when you get these big bear give-up bars, the market rallies above the top of the give-up bar before you start a channel down. This is often the spike of a spike and channel pattern. Like this, we have a bear bar, and the market went sideways for five bars or so before we went a little bit down. Here we reversed much of the bar. We had a couple bull bars before we went down. We've been sideways for 2 days after a bull trend. So breakout mode for trend resumption up or trend reversal down. Because there was a trend prior to the trading range, even after whatever this is, 150 bars, the odds still, I think, are slightly higher that we get trend resumption up than they are for trend reversal down, because on a higher time frame chart, this becomes a bull flag. And so even though on the 5-minute chart it's a tight range, on a higher time frame chart, it's only, if you pick a high enough time frame chart, it's only a few bars. Here's a 240-minute chart. So it's only, 3 sideways bars after a strong reversal. Odds are we'll get at least a little follow through. And, yesterday we opened with a couple dojis, and it was mostly a trading range day. Today we opened with 3 dojis. You can call 2 a doji as well. And the day was a trading range day, but a much bigger range than yesterday. We went above the high of bar of the first 18 bars here, immediately reversed, and traders sold the reversal. And we had bad follow through on 22. And I think it's fascinating that 22 became a very important bar. Because it was not a third consecutive bear bar, it was still always in long. I still thought we were going to get a lower high. However, the bulls were able to get a higher high out of it. A little bit of a parabolic spike and channel pattern, spike, pullback, and then 1 push, bear bar, 2 push, and then 3 push. I was not expecting a reversal to a new low. But once we get that breakout 41, the odds were we were going down for at least a measured move down. Then we got another big sell climax bar 45, but the bulls could not get above the bull bar. We had a micro double bottom here and a bull inside bar here. So it's a wedge, 1, 2, 3, failed breakout low of the day, but a very tight bear channel. So the first reversal up, even if it goes up 10 bars, is probably minor, and we're probably going to have to test back down. The reversal down was much bigger than I thought it would be, but micro double bottom, and it's unusual to have this much support at one price. The low from 2 weeks ago, 60-minute moving average, yesterday's close, bottom of the channel, a little bit more than a measured move down. And then we get the micro double bottom, 61, and that ended up as the low of the day. However, it really is interesting that there's so many things going on here. Bottom of the channel, failed breakout, low of the day. So that made it unlikely that we were going to collapse and sell off. It's always possible, but unlikely. And once we started to reverse down, the open of the day becomes a target. If you have a lot of trading range price action, I talked about how this was not likely going to be a small pullback bull trend because we were getting too much overlap. Bar 9 overlapped the high of 3 by 2 ticks. And then here we went sideways for too many bars. So not really a very good gap above 9. And up here, again, pulling back below the 14 high. So it looked more like a bull leg in a trading range day than a beginning of a small pullback bull trend day. And we got a second leg up. We had about a 10 bar, 12 bar bull micro channel, and yet we reversed down. The short, if you were taking a stop entry short, I would not sell below 35. At that point, 11 bar bull micro channel and a bull body, and selling below 36 and bear doji, not good. So the stop entry sell was probably below 38, and then the sell the close sell was on the 41 close. 40, 41, not particularly big, so probably not going to lead to a huge bear trend, although it fell further than I thought it would, plus the tail on 41. And we tried to reverse up from a double bottom higher low at 42 with 24, but the odds were we'd get at least a small second leg down. And then we got 45. And whenever you're expecting at least a small second leg down and you get a big leg down like that, we're probably going at least a little bit lower. I said that it was only about 10 bars into the bear trend, and therefore it was probably not an exhaustive move. We were probably going to get at least one more leg down. I was not confident we'd get a measured move down. However, when you have an open of the day that's now in the middle third of the day, you always got to be thinking that the open might be the exact middle of the day, so we might get a measured move from the high to the open down here. We reversed up 48 and again 55, but I said I thought it was a minor reversal because the channel was tight, and I thought there was a problem. We got to within 3 ticks of this measured move, then 2 ticks of the measured move here, and that's usually not close enough. If you get to within 1 tick and reverse up, that's often close enough, and you do not have to get back down to the target. But if you reverse up from 2 or 3 ticks above the target, usually the market will have to get back down to the target. And that's true even with the strong reversal up that we had here. And we also had other targets below. We had the measured move target, the 60-minute moving average, and the close of yesterday. As strong as 55 was, it's probably a minor reversal, which means we probably would test back down, maybe to the support below. And we sold off much stronger on 58 than I thought we would. 59, another big bar. Now we are 20 bars into the bear trend, and we're getting the biggest breakout of the bear trend. So this is 60% chance a climactic end of the trend. That does not mean reversal into a bull trend. It just means that the bears will probably stop selling for at least 10 bars and 2 legs. So 1 leg, 2 legs. But now we're at the end of the day in a tight trading range, and the bears decided to wait until tomorrow. For stop entries, it was all limit order trading for that first hour. The first stop entry short, the first stop entry trade that I thought was reasonable was 4, but you have to get out above 6. And if you're quick, you reverse to long above 6. And usually in a situation like that, we have a reasonable sell, like below 4, and then you get stopped out, like 1 tick above 6. If you reverse, it usually goes up far enough to make up the loss, but it's hard to do. It's hard to reverse. And then as far as selling below 18, I was aware of the parabolic wedge, but I thought we would go more sideways, and I thought the odds were against stop entry bears making money on the first leg down, but they did. And then buying above 24, that 22 bull bar after the 2 bear bars, I thought that the reversal was minor and that we would test up, probably to the 19 low. I did not think we would go up to a new high, but we did. But for me, I was buying with limit orders, 22 low, and not with a stop order here. Had I bought with a stop, I probably would have put a stop down below 3 and looked to add on lower. Buying above 29, we have an II after a surprise reversal. Bull bar is getting bigger, right? Accelerating out, probably going at least a little higher, but probably sellers somewhere above 19, and there were. And then on the stop entry sell, the first one that I would consider would be 38. I would not buy 43. In fact, I was selling above 43. And then 44, a low one. I did not think we would break that strongly to the downside, but as I said, the bulls had an attempt at a double bottom, 24.42, and it looks like everybody gave up when it fell below the 24 higher low. And then we had another low one, 47. The bulls could not get above 46, so the always in bears were still short. However, I think the big tail on the bottom of 47 and all of those targets below, if you sell below 47, you're probably going to end up scalping. And then here, not a good looking stop entry buy above 54 or 55. Above 50, I'm not opposed to taking that buy, right? I think it's an okay buy, but you probably need a wide stop. And what's a wide stop? Maybe all the way down here below the bottom of the bull trend. And then I would not take that stop entry sell. This is probably an okay buy, but I was buying with limit orders, and I would not do any stop order trading in here. Buy the close, sell the close. It was interesting. The first 18 bars, you knew it was going higher, but it was never quite strong enough for traders to want to buy closes or buy at the top. If you think you're in a small pullback bull trend, you see gaps, then you can buy closes and buy at the tops of bars. But when you don't see that, you have to assume it's a bull leg and what will become a trading range. So hard to buy closes here. This was a surprise, so buy the close if you want for a little bit more up. And then 41, 42, sell the close. 45, a surprise. I think okay, sell the close. Disappointment, 46. If you sell the 45 close, you got to be thinking about scaling in 1 or 2 points higher, and that would have worked. And is 55 buy the close? It's a big surprise, but it's probably a minor reversal, and that means a bull leg in a trading range or even a bear flag. And if it's a bull leg in a trading range, buying high is difficult to do. So that to me is not good buy the close. 58, a surprise reversal, but you have to be really quick. Chances are we're not going much lower. We have a whole bunch of support just below. And then on the reversal up, I think really not great buy the close, maybe 64, 65. And if you bought 65, disappointed 66, and then you spend your time here just trying to get out to avoid a loss. Limit orders, it was really interesting. Bulls made money below 1 and 4 is a sell signal, and bears made money above 3 and above 5, and 5 is a buy signal. They made money above 6, and 6 is a buy signal as well. So that was warning us that today was probably going to be a trading range day. Bears sold above 17 and 16 and made money. bulls bought below 19, and below 14 and made money. Bears probably okay to sell above 24. We're still always in long though, and there still could be a bull flag. So if you're selling above 24, you have to use a wide stop, maybe a measured move up based upon the height of that leg, so a little bit above that measured move target. And then here, I would not sell 29, but I would sell either 19 or 1 point higher, although you were not filled. And then on the way down here, second leg down likely, so 43 high, okay. Sell climax near the low of the day. I would not sell below 47, but I would rather be, if I'm buying below bars, I'd rather buy below 46 or a point below, just in case we get vacuumed down quickly to all that support. And the same is true with any of these limit order buys all through here. As far as selling above 53, I thought we were in the buy zone, not quite to the target, but probably pretty close, possibly close enough, so I would not sell there. And then 60 low is a buy, 67 low and 1 point lower is a buy, and I did not take any trades in here. The moderators forgot to pop up the question box, so I just put it up right now. I'll wait a minute to see if anybody has any questions. Okay, a question about the US dollar and the Canadian dollar, 15-minute chart. Okay, 15-minute chart. On the 15-minute US dollar versus Canadian dollar, I bought many times for a swing at 4 a.m. Okay, so around here. And then 11:15 a.m. Pacific time, and scaled in lower, taking a loss on all of them. I never went short today. I understand, that's a common problem, right? You see a sell-off and it does not look particularly strong, and you assume it's going to bounce. For example, so he bought at 4 a.m. on the reversal up. My problem with that is the one, you hear me talk about it all the time. When a channel is really, really tight, I don't want to be buying with stops. If I'm buying, I'm only buying with limit orders below bars. And I usually like to, so any reversal up here is minor. And even though the sell-off has bars with tails on the bottom, and it's probably a bear leg in what will become a trading range, the limit order bulls are not making money, or they're making very little. And that makes me really hesitant to buy. Okay, then we got an attempt at a wedge bottom, and then we got that. And, we have a bear breakout below a reasonable bottom, and we probably get some kind of a measured move down from that. Okay, and then 11:15. Okay, so he bought here on the bear breakout below the wedge bottom, but that's a strong enough breakout to make me think we're probably going at least for a measured move down. So, it's just one of those days that, you just look at it and all you're seeing is a weak bear trend, especially through here, and you're expecting that the market will be forgiving, and if you scale in, you should be able to make money. But, I've been there, many times, a lot, not so much in the past 15, 20 years, but before that, all the time. You see a sell-off where you get a lot of tails and a lot of overlap and some decent bull bars, and you think, okay, I know the channel is tight. I know the reversal will probably be minor, but it's enough buying pressure so that I have a pretty good chance of making a profit. And now when I look at that, I say, I see all the tails. I see the bad follow through after the bear bars. I see the absence of consecutive big bear bars. This is probably a bull leg in a trading range. and I'm willing to buy, but I want to see the market go sideways. Would I have bought above that? No, I would not have bought above this. You can argue expanding triangle, 1, 2, 3, good looking bull bar, but following 3 good bear bars, I would want a micro double bottom, or I would buy after I see a strong reversal. What I like to see in a bear channel is a minor reversal that is very strong. In other words, I want to see a strong reversal up. And when the channel is tight, the reversal up is still minor. But that's what I want to see. I want to see a strong minor reversal. Because if I get that, then the next leg down probably will result in an attempt at a major trend reversal or a trading range. And until then, I don't like to buy. Even if I see a lot of bull bars, I always ask myself, I'm seeing the bull bars, but why am I not getting above prior significant highs? This is a fairly major lower high. We have 3 bear bars and a new low. This is a minor lower high, so going above it does not mean anything. And I don't want to be the first trader to make money on a counter trend trade. I want to be the second or third trader. I want to see somebody else. If I have a plan, to buy, and I want to look and see if somebody else already made money using my same plan. I don't want to try to catch the first successful version of what I'm trying to do. I want to see proof that the market has succeeded in doing what I'm expecting it to do again, and not and I don't want to bet that I'm buying the first strong minor reversal. For me to be buying minor reversals, I want to see prior minor reversals that are very strong. So for me, even though this looks like a weak sell-off, I'm certainly not buying with stops. I might buy with limit orders, but if I'm buying with limit orders, excuse me, I'm going to be scalping, because any reversal is going to be minor when the channel is tight like that. So I think it's just an issue of trade selection. And at some point you start betting on regression to the mean. It can't keep doing this forever. Eventually I got to be right. But there's that adage on Wall Street that the market can continue to do something unreasonable or stupid far longer than you can maintain your account. So betting on regression to the mean, in general, if you're betting against a trend where the market is below the moving average the whole time, it's a losing strategy. You're going to lose. A lot of times you'll get rewarded just often enough, not to make money, but often enough to make you try it again. And the result is you end up losing money doing it. So I think it's trade selection. Question: I bought the 19 low and did not scale in after the market went lower. I exited break even on bar 27. Is this acceptable management, or is the trader's equation only positive for this type of trade if I scale in? No, what you did made sense, right? Sorry, I'm losing my voice. So he bought the 19 low, betting that the channel is tight and the first reversal down will be minor and lead to a trading range or a bull flag. So if it's a bull flag, it'll go to a new high. If it's a trading range, it'll test back up. So buying that 19 low and putting the appropriate stop down here is reasonable. What about buying the 35 low? Can you do the same thing? Well, what's different here is we have a second entry short, and if it's a trading range, this pullback is deep enough. It's a deep enough minor reversal to make traders think that the market might soon enter a trading range. And if you're getting a new high and a second reversal down, to me, you got to get out of longs. Question: can you explain the math of using a very wide stop, scaling in and scalping? For example, if a trader is willing to use a 10-point stop and go for a 1-point scalp, why not use a 20 or 50-point stop if he can afford it, since greater risk will probably since it'll probably increase it'll increase probability also. Okay, so you're asking me this question. You're thinking like a hedge fund manager. Okay, here's Variant Pharmaceuticals, and it's a trading range. Here's the monthly chart. Okay, and I can't remember the guy's name. You've heard of Carl Icahn. I think Carl Icahn is brilliant. I think he's really smart, and he's an outstanding trader. He's in his 80s now. He's probably one of the top 10 or 20 richest people in the United States. He probably has about 15 or 20 billion dollars, and he made it from trading. I'm trying to remember the guy. He's always let me just see. Let me see if I can find his name on the other computer. Ackman. Okay, that's the guy's name. Ackman. Okay. Bill Ackman is a hedge fund manager. It's kind of like Trump compared to Bill Gates, or so Trump is a mini billionaire, and Bill Ackman is a mini hedge fund manager. I mean, he's big compared to you and me, but he's mini compared to Carl Icahn. And twice over the past couple of years, Icahn has basically screwed Ackman. I don't know if he did it with Valiant, but he did it with Herbalife. It was really funny to see the two of them on TV. This is the monthly chart of Herbalife. And Matt Ackman went on television announcing that over here that he had concrete proof that Herbalife was a fraud, a Ponzi scheme, and it was going to zero. And then soon after he was on TV, I don't know, a week or two later, Carl Icahn went on TV and said, I called one of my buddies. I gave him $1,000 and I told him, look at this, analyze the financials on Herbalife and tell me if it's going to zero. And my buddy said, no, it's fine. It's not going to zero. And then Icahn said, okay. And then Icahn went in and bought hundreds of millions of dollars of Herbalife. And here Ackman was heavily short, betting that it was going to zero. And Carl Icahn bought hundreds of millions of dollars of Herbalife, and this was the result. So, Ackman, I don't know if he ended up losing money or if he traded his way out of it, but, he was overwhelmed by Icahn. And the two of them were on stage together one time, another time. They've said a lot of horrible things, nasty things about each other. And on TV, they asked Icahn, he said, are you mad at all those terrible things Ackman's saying about you? And Icahn smiled and he said, no, Ackman's my friend. He gave me several hundred millions of dollars. How can I be mad at him? This is where Ackman gave Icahn several hundreds of millions of dollars. Let me go back to Valiant. It's another Ackman trade. Okay. I don't know where Ackman bought, but he bought somewhere up here, betting that Valiant was going to go higher. Obviously, if you buy, you think you're going higher. And guess what? He held long, right? Thinking that, it can't go all the way down to zero. And he's right. It didn't go all the way to zero. He got out when it was like 15 or 20, and he lost 90% of his investment. And it was no small investment. Nobody knows for sure how much he lost, and I don't know how big his hedge fund is, but I've seen reports that he lost about $2 billion betting on regression to the mean. And this is what you're talking about and what the last question was about as well. Buying and using a wide stop. Wide stop gives you a high probability, but the low percentage time that you lose so much that you get killed. And that's what happened to Ackman. he bought somewhere up here, and he probably bought more on the way down, betting that he would average in and avoid a loss. And he eventually gave up down here. And even when he gave up, I don't remember which month he gave up, but he gave up somewhere in here. And he said, "Oh, I'm giving up, but I still bet that it's going to double," which to me is kind of silly. You're betting it's going to double, but you just took a huge loss, and you probably lost, 10, 20% of your firm's money on that one trade, which is stupid. But anyway, back to your question. Using a wide stop greatly increases the probability of making money, but you still have a finite, real, small probability of losing money, and that small percentage of the time that you lose with your wide stop, you lose a lot. So Ackman lost, 20% of his fund's money on a single trade, betting that he'd make money. Now, let me just talk about one other thing. Okay, Carl Icahn. All right. This is Freeport-McMoRan. Flip it to a daily chart. Okay, well, I'll use a weekly chart. Freeport-McMoRan is collapsing. It was $40, and then it's $20, and then it's $10. Well, guess what? Down here, when it was at $10, Carl Icahn said, I think it looks good. I don't think it's going to go to zero. I'm buying it. And Carl Icahn typically scales in. So if it's at $10 and it goes down to $5 and he loses 50% of his trade, and he still thinks his premise is good, Carl Icahn's buying more. I don't know how many times he bought, but he bought at around $10, and my guess is he bought $5, and when it got up to $10, he could get out break even on his first, and with 100% profit on his second, and then it went up to $15, and this became a triple. So it went from $5 to $15. So, and he probably used a wide stop. His stop was probably zero, and so he was willing to risk 100% of his trade, which is, that's as big a stop as you possibly can use. And he did it, and he increased his probability of making money, and he ended up making, hundreds of millions of dollars. I'm assuming hundreds of millions of dollars, given the position sizes that he takes. Now, back to your question, back to the E-mini. Now, go back to the question. Can you explain the math of using a very wide stop, scaling in, and scalping? For example, if a trader is willing to use a 10-point stop and go for a 1-point scalp, why not use a 50 or 100-point stop? Because you'll have even a higher probability of risk. I talk about that in the videos. At least I think I talk about it clearly enough. And I said that if you're scalping and using a wide stop, you should be using a swing stop, and that's never going to be 50 points on a day trade. And sometimes it could be 10 points on a day trade, and you don't let your stop get hit. So if I'm buying, let's say I'm buying this low, right? Let's say I'm buying this low, and I put a stop down here. And then I see this, a second entry failed breakout above that high. I'm going to get out here. I'm not going to let my stop get hit. If I buy this low and I put my stop down here, I would get out if I had a third consecutive bear bar. I did not. And if you remember, when we were down here, I said, pretty good for the bears, but I think we're still always in long. And therefore, a trader buying that low and scaling in and using that stop, he would stay in until it became clearly always in short, or until it hit his stop. And his stop is a reasonable swing stop. And a reasonable swing stop, can you ever use a 50-point stop? And is it ever reasonable? Yes. Once every 10 years or so, you'll get a day where the range is 100 points, $100, 100 points in the E-mini. And sometimes the appropriate stop is 70 points, 50 points or 70 points. And obviously most traders cannot trade that, so they simply watch, or they trade something else, like an ETF, like VXX or the QQQs, or they day trade weekly options. But my point is that if you're scalping, buying that low, scaling in lower, and using a swing stop, the math is okay. But if you're scalping buying this low and you get a reasonable sell setup, you get out and you don't let your stop be hit. And your swing stop is never going to be unreasonable. If your swing stop is unreasonable, 50 points, you don't take the trade. All right. And I give some examples of the math in the videos. The key point is your entry reasonable? Are you taking a reasonable entry? Is it reasonable to buy the 19 low? Yes. Okay. Where's the reasonable stop? Down here. What happens if it hits the stop and reverses up? Well, you get long again if it still looks like a reasonable buy. So if you take a reasonable trade, use a wide stop and scale in, it's reasonable to do. Dollar cost averaging. You've all heard of that. If you have, let's say, $100,000 and you want to buy stocks, a lot of financial advisors will say, don't buy all $100,000 today. Buy 10,000 this month, and then 10,000 next month, and 10,000 a month for the next 10 months. And that approach to investing is called dollar cost averaging. You may be buying your second $10,000 at a higher price or a lower price, but over the course of the year, you'll be basically buying the average price of the year. And since the stock market, if you buy at any given time, I don't think at any point in the history of the stock market has the market been below your price 5 years later. So if you bought at any particular time and you held for 5 years, let's say you bought the S&P or the Dow and you held for 5 years, I don't think there's been any time in the history of the Dow or the E-mini when you would have lost money. And therefore, dollar cost averaging, if you buy over the course of a year, you're getting the average price of the year, and you don't risk buying at the high of the year. It's a reasonable way to increase probability. And it could involve scaling in. If you're buying in 2007 or 2008 when the market's falling dramatically, all right, so let's say you just received an inheritance of $100,000 right here, and you decide you want to start buying. The market fell, whatever this is, 60%, 60 or 70% from the high to low, and you just buy every month over the course of a year. Your highest entry price would be here, your lowest entry price would be here, so your average price would be around here, around 1,200, and it took a while for you to get back to 1,200. Okay, it took about 3 years to get back to your average price, and since then, over the past 7 years, you've doubled your money. So I hope I'm being clear on that you don't use a stop that is unreasonable. You use a reasonable swing stop. If the stop is too far for you to take the trade with whatever additional entries you're going to take, you don't take the trade. And if the market reverses and clearly becomes always in short before your stop is hit, you get out. And talking a lot today, I'm sorry about that. Okay, question. How would you mind explaining the measuring gaps on the NASDAQ today? I made 50 points, but I missed 100 points because I got out too early a few times and stayed in too late. There were lots of measuring gaps and leg 1, leg 2 measured moves, and I don't know which ones to use. Okay, but if you made 50 points, that's a really nice day. Okay, that's about the entire day's range. The entire day's range is about 50 points. One thing that when traders when somebody asks another trader, how much money do you make? Obviously, no one's going to answer. And then they'll say, well, how many points did you make today? And they may or may not answer. But one thing traders sometimes talk about is how much they made relative to the average day's range. And decent traders like to make between 1/2 to 1 times the average day's range. And for the E-mini, the day's range is about 10 points. So a decent trader would hope to make 5 to 10 points net total on the day. A really good trader would be trying to make 1 time to 2 times the day's range. So if the day's range is 10 points, a really good trader would be trying to make 10 or 20 points total on the day. But anyway, back to the NASDAQ. Okay, Al, would you talk about the measured moves in the NASDAQ? Well, obviously we got first obvious one is we sold off, we broke to a new high. We have a little bit of overlap, but you got to be thinking about a possible measured move up. That this is possibly a measuring gap up here, and you can see when we got there, right? So if you were able to hold long, you try to get out around the measured move up, and then on the way down, you're looking to say, huh, that's surprisingly strong, and therefore it could lead to a measured move down based upon the open of the first bar to the close of the final bar down here. And then we're totally reversing this. We have an attempt at a double bottom. We're breaking below the double bottom, and therefore you're going to be thinking about a measured move down from a failed double bottom, either from that low, and if it falls below that low, then you got to be looking at the lower low from the double bottom, and we got down there as well. And to me, those would be the two measured or the few measured move targets that I would be thinking about. And then beyond that, to me, if you made 50 points, I wouldn't worry about being perfect. And I would not necessarily get out at the limit order based upon this measured move, right? However, if I saw it get up to the measured move, right, and start to reverse down, I definitely would get out here, especially because of a parabolic wedge. 1, pullback, 2, pullback, 3, pullback, 4, and wedge 1, 2, 3. So whether or not you get short, I think you get out of longs up there. And here you can call this a measuring gap. I would call it a failed double bottom attempt. In either case, I'm looking for a measured move down, and measured moves up based upon that, not worth it. The major swings were the ones that I said I didn't even look at over here. But strong sell-off, sometimes you get a measured move up from the low to the high. Did not quite get there. For Facebook, what's a decent scalp size? In general, if I'm scalping in a market, it's not Facebook. My general rule for a scalp is that I look at the average range over the past few days, and a scalp for me is going to be 10 to 20% of the average range. So if the average range is $1, the smallest scalp I would want would be 10 cents or 20 cents. On a $200 stock, I'm not going to be scalping for 10 cents. I'm probably going to be scalping for, at a minimum, 20 cents and probably looking for 50 cents. What about here? Buying above here, around 170. So to me, I probably would be looking for closer to 50 cent trades. However, my general rule is 10 to 20% of the day's range. So yesterday, the low of the day was 170, high of the day 170, 150. So 10% would be 15 cents, 20% would be 30 cents. Then I also look at the size of the legs. And, if I see the legs are 50 cents or more, I would rather try to scalp for 50 cents. But my general feeling is when I see a $150, $200 stock, I'd rather try to scalp as close to 50 cents as I can. And I would not be scalping for 10 cents. I might sometimes scalp for 20 cents, but even that, I would not be happy about doing that. You also want the profit size to be, you want the bars to be big. So what's the low of this bar? Low of this bar is 170, high of this bar is, so it's about a 30 cent tall bar. That's another guideline. So if the bar is 30 cents tall, I'd like to be scalping for somewhere around the height of the bar, maybe a little bit less, so 20 cents. So when I'm looking at today's price action, if I were scalping it, I would be looking for 20 to 50 cent moves. Okay. To me, I think this looks like a bull flag, so bull channel, and then a bear channel to a higher low. It looks like a wedge bull flag. It looks like we're trying to get the breakout. And on the daily chart, I don't know if we go to a new high, but if we do, I think the odds are that the sellers above. The bears wanting the lower high probably will need a micro double top after this strong reversal up. Okay, hope everybody has a good night.